Welcome to our live profiling Q&A session. We try to do these on Fridays, and it's an opportunity for us to kind of recap the week, look towards the next week, have some expectation, and to actually work on developing as traders. So the assumption is that if you're here on the session, you're looking to develop some aspect, hey brother, of your trading. And so this session is really for you. We really have tried to design this so that you can, kind of ask us anything, and we'll try to do what we can to make that helpful for you. Before we get started, we always want to begin with just a recognition that there is risk in financial markets. I mean, there's risk in life in general, but just the compression of risk that's seen in financial markets is something to be aware of. And so be mindful of that as you're expressing an opinion in them. This is myself. I'm Josh. I'm the founder of Trade Profile. Just a little bit of my background and where I'm coming from. Kind of came from the retail side, stumbled on trading, and got really excited about it. And then everything kind of changed for me when I got exposed to the profile, and that really helped me get to the institutional side of the industry. And also on the call with me is JP, who has been in the industry as well. I mean, between the two of us, we're pushing 25 years of market experience.
It's got to be longer than that.
Got to be longer than that. We're here to serve as your guide, and we're here to serve your guide in moving towards being a consistently profitable trader, which we find that is at the nexus or the intersection of these three objective focus areas. And that is that there are 4 behaviors observable in every auction, and we seek to be able to know what those are and to observe them. That there's 4 questions that we ask before entering a trade, and then we know how to answer those. And then there are 4 stages of auction competency, and you know which one you're in. We find that traders who understand these dynamics and the interplay around them are moving closer and closer towards consistent profitability, which is a key outcome for anybody in markets. Specifically today, we're going to apply that focus toward this challenge. So the challenge is when you come into a trading session, which way should I lean? Long, short? Is it okay to have a bias? If I pick one, how do I know when it's good, or how do I know when it's no longer valid? So this is like the basic. We talk about building a trade plan and having a trade plan for your session. This is about as simple as you can get, is just to say, hey, who do I believe is going to have control in this coming session of the market? And just for your understanding, we are primarily what we would call intraday swing traders. So we are not scalpers. We're not looking for every little movement in the market and trying to trade multiple times a day. We're looking for 1 to 2 good trades intraday that we can define a tight risk relative to hopefully at least a 3x reward for that risk. Nothing wrong with scalping or looking for multiple opportunities. One of the things that is a downside to that is you can increase your costs, because every trade you place, there's a commission involved in that. And also you can get exposed to a larger move. So we're looking to capture the larger moves intraday, but this requires a form of bias. And so, what is bias exactly, and how do we define that? So the principle that we use is that the profile is a tool that allows us to arrange price to make better trading decisions. This is simply what it is. It's not a trading system. It's a way that we're organizing the information that's in the auction day by day to give us reference points. And when we bring in those 4 behaviors that we referenced just a little bit ago, how we're expecting the auction to behave around these reference points, which can help us establish either an intraday or a multi-session bias of the auction. And the risk, we think that you should have a bias. And the risk is that if you don't have a bias, what ends up happening is that a trader is unaware of subtle shifts in control of the auction and ends up on his or her heels. Meaning, easier way to describe this is that you don't know when you're wrong, and so you will either double down on a wrong trade, or you hold on to a trade that should have been exited a long time ago. So a bias can be really helpful on the risk side. And if you've been on these calls before, you know that we hammer this. Like, the only thing that you have absolute control over in the market is how much risk. That's it. You have no control or influence on which direction the market's going to go. You can have a really great story and narrative for where you believe it will go next and why it will go there, but that's subjective. The only thing that's really objective is the risk. And so having a bias is a key component of that, both the narrative and how much you're willing to risk around that. The outcome of having a bias and understanding how to use the profile to set one is that you can determine a bias before a session begins and know how and when that bias is confirmed or challenged. Okay, so what I want to do is I want to show you just a couple ways that we do this, and this is actually going to be the focus of our community next week. Is we're going to be talking about how do we select a bias for the coming session, how do we know that that's in jeopardy, and how do we use that. But let me just do a couple things. We're going to go over here and look at some charts, and specifically, I want to show you. Let's look at crude oil, and actually, we're going to look at it this way. Okay, so just some quick orientation here. And I'm using crude. I mean, you can use really any trading product, whether equities or futures. But you'll see there's a line right here. This yellow line is what I call a pre-IB bias. And so part of my plan this morning, or actually my plan last night, was assuming the auction held above this level right here, I was looking for the auction to push towards 57.70. But if it got below this, then it could expose the auction to some downside risk. Right now, let's look at how this auction behaved. Early in the session, the auction tested this level and pushed higher. Actually, in Globex, we got up to that 57.70 area. But you know, after the first hour's trade came in, you can see there's a bunch of sellers that came in. We had some big selling volume, pressed through this level, and now that is changing the bias. But the question is like, why this price? What is it about this price? And what that is if I look at yesterday's auction, okay, so let me show you yesterday's auction. It's just a simple way that I tend to set bias. Is there something in profiling that's called the value area? Okay, so this is where 70% of the volume of the trade of the day, the range of that price takes place. And we closed up here around 57.20. We had a most traded price was here at 57.10. And you can see that this pre-IB bias level is right below that value area. So from day to day, the value area reference can be helpful in setting an expectation for the auction. So if we're trading above yesterday's most traded price, often what we'll see is an auction come back and test that and then push off and move higher. But if it gets below this, then it's basically starting to negate where traders accepted price the prior day, and that can open you to the downside. So that's why that price was there. Now, I have a couple different biases that I have coming into a day, and I just want to show you a couple of those. We're just going to look at the crude plan that I put out last night. So let me get over here to an area. Okay. So this is my plan coming in to the morning. So I was looking at how the auction traded, but I was saying I'm looking for that 57.78 as long as we stay above 56.85. And I actually have two different bias levels. So I have one that's an intraday that I call a pre-IB bias. And then I have another one that's called a swing bias. So that's like a more multi-session bias. Sometimes these are in agreement, sometimes they're divergent, meaning in a shorter time frame, I'm expecting the auction to go one direction, but in a longer time frame, I'm looking for it to basically stay its course. That's trying to take into account for that. The other thing that's doing is what I mean by a pre-IB bias. So if you joined us last week, if you missed it, no worries. You can go back and you can look at the recording on our site. But prior to the initial balance being established, the initial balance being the first hour of trade, so that's what this green bar here represents as the first hour of trade. Prior to that being established, we don't really have any type of expectation probabilistically around one side holding or not. But once that hour is complete, we actually do have some statistics that kick in on the probability of one side of that auction holding. And the stats are about 30% that once one side is extended, the other side. So that's what made today, if people are like, well, how did we get such a big day today in crude? Part of that is because we had already extended the initial balance high, which meant that to take out the IB low, there was only a 30% chance that that was going to happen. This is going back over 1,000 trading sessions, pulling these stats, that they took out the low. That really gave the auction confidence to explore lower. Now, there's other dynamics at play. There was a prior gap zone that was at play. There are some key inventory levels down here that we're looking to get to, which we're now into that area. So all of that compounds. But just as a real basics, but I have a bias level that I'm setting if I'm active before that first hour is complete. That's kind of the level that I lean against. Once that first hour is complete, then I shift to what that IB range is. But it's a way for me to control risk and to say, how am I going to defend that? So, prior to the first hour being traded today, this 56.85 area, the 97 area, that's an area that I was looking. That's an area that I was looking to defend early on. And then once the IB actually established, then I was actually defending 56.85 as the initial balance low if I wanted to be long. Once they went across that, then I'm basically trying to be short, and my risk is 57.55. Now that may be too wide for people's taste, so then we have setups that we use inside of that. But that's a general idea. So a bias level is it requires a couple things. It requires that you have an actual understanding of what's likely to happen next in the auction, and that's those four behaviors that we talk about in the auction. Is the auctions, they move, they rest, they test, and then there's another move. Oh, here comes this structure cleanup trade, guys. We were talking early in our community. There's these single prints right in here that we're looking for these things to be filled in with another 30-minute period. We were looking for it to get all the way down here to 45 first, but they may not let us get that far. We'll see what happens. It's not as attractive because they've migrated the point of control lower, but that's it. So a bias is just simply a simple part of your plan when you come into the day. Are you looking for for the auction to behave to the upside, to the downside, and what price would change that perspective? Now, just because you have that's one layer of the onion. The next layer of the onion is, all right, if it moved in that direction, what setups in my trading playbook do I express inside of where that auction's going? So that's the next level. So we always start with kind of a narrative of what we believe the auction's going to do first. Make sure that we're in flow with the auction, and then we're applying our setups inside of that. Okay, so that's just a very quick high-level idea around the idea of a bias. Obviously, if you traded below 57, I don't know how obvious this is, but for my plan, trading below 57, 85 to 95 before the first hour, I would have been suspect of any longs. When they traded below 56.85 after the first hour, I'm absolutely suspect of longs. And when they traded below 56.70, which was my multi-session bias, that basically set up could be a multi-session swing the other way. So we've actually gone through all of those bias levels. So that's to prevent me from being and holding on to longs, which you can see here would have been a really good idea to not be long, right? There's at least $1.20 of long risk, which that's $1,200 per contract on the crude that you would have absorbed in risk if you tried to hold on to this trade. That's a recipe to blow up your account. And then when for Monday, so this is Friday's trade. So like my bias, obviously this is a strong directionally charged move to the downside. And this is what we would call a multiple distribution trend day in crude. So one of the levels that we'll defend will be this 56.70, which is what we call halfway back in the auction. So that will, in fact, I'll just go ahead and do a little homework for my weekend here. I'm going to move this level down. Okay, so coming into Monday, my bias is that sellers have control of this auction unless they can trade above 56.60. If they start taking back half of this range, then I would, consider that the selling could be in jeopardy. So I hope that helps. The idea, if you're not using or applying a bias right now, that's what I would encourage you. Just as a very simple part of your plan is to come into each session with, here's the general, belief in the auction. Is the auction moving higher? Is it moving lower? We ask what direction is the auction attempting to go and how well of a job is it doing? So, until that, what would change that? What would change that? A bias can really help set that, and then track performance on it. If you set a bias and that level is changed, try that. And if you have no idea where to start, spend next week with us. We're going to spend the whole week talking about bias and when it's challenged and how do we construct a bias for the current session or coming sessions, and where that changes mid-session as well. So with that, we're just going to open the floor to any other questions and go from there and see where the wind takes us. So great question. So what is the best, Nicholas, second question. So where's the net current balance, multi-composite volume point of control and that current balance in the CL? Well, so on a weekly, I look at a weekly composite, and I look at a monthly composite, and then a 3-month composite. So the weekly composite was this 57.10 level that you can see up here, which that's a key level. There's a lot of inventory. That's what this graph here is this is inventory. So you can see that most traders traded on this price of any other price in the past week. So when the auction tried to go above that and couldn't, and came back through that set the condition for them to push lower. And then where auctions go to the next place where there's significant inventory, which is here. So that is the next spot. I would imagine that if we can spend some more time down here, we could actually migrate, and this would become the new rolling 5-day composite, which is a form of the auction accepting lower prices. Okay, what's the best way to trade a trend day?
On the right side of the market.
Yeah.
That's a great question, Scott.
So one of them is how to even identify a trend day. Okay, and there's a couple things. The nomenclature that we use is something called one time framing, and this typically takes place after the first hour's trade. So here's the first hour, and then you can see here in C period, and then D period, and then E period, and then F period, like everyone makes lower lows, lower highs, lower lows, lower highs. So a trending market is going to continue to do that. Other things structurally that are going to happen in a trending market is statistics of the range. So let's look at the initial balance here and measure this. So if I look at this range, a trend day is going to exceed 2 times, or basically double, the initial balance range, which gets you to here. Okay, so this is a trend day. So if you believe it's a trend day, a couple things. Your target on the trend day is more time-based than it is actually target-based necessarily, because a trend day doesn't see its extreme until the end of the session. Like the lowest price would come in the last hour of trade. So that's one component you're staying at. The other thing is, does trade stay outside of the initial balance? So if you get back inside the initial balance, likely not a trend day. Trend days get out of the IB and then they're gone. They don't come back. So then what you do is if you believe you're in a trend day, we look at short-term time frames and look for pullbacks on some type of trigger time frame to get into the trade and join it. So unfortunately today there weren't really great places to do that, but I think these are 5-minute periods in crude. But you can see the real first big push. There was a little bit of balance and actually a push higher, and then there was an engulfing 5-minute period right here. Like that's a place that you could enter right there, and then your stop would be here. And again, your target is either some macro composite, which would have been down here, or you're holding it till the end of the session. I will tell you, and JP the same. I'm not a great go with trader on a trend day. Typically, I let them go. I'm much better the day after a trend, because
yes, for sure.
Because typically, and the reason why is, so when you see a big move like this, it changes market participants' expectation for the next day, and they start thinking, oh, we're gonna have a big day the next day, and really they miss that move. So there are much better responsive opportunities the next session, and typically a more muted range the next session than after the trend day. But that exactly is how it's what we call a pullback continuation trigger. They're using a short time trigger that you can get the risk tighter to go with the trade. But
yeah, everybody wants the big trade. I think that's probably where you're going with that, and we all want to capture as many points as possible. But one thing you have to remember is that most days are not trend days out there. The percentages are very low that we have a true trend day. That you have to be pretty much a go with trader at that to catch that, or you have to be savvy enough to be in that trade prior to the trend happening. Most people don't know the trend's happening until it's over. So like Josh, 9 times out of 10, we'll let that sucker go, and we know exactly what to do the next day, and we can do very well the next day based off of that.
Mm-hmm.
And you have a question about merge profile?
So it's within the range, just to see how it lines up with the composite you have displayed on the right screen.
Hold on a second, Scott. So do we prefer that? Okay, so for me personally, so I'm going to answer this personally, and then Josh will probably answer it totally different than I. That depends, because I don't look at my days as responsive days or not. I look at my trade setups, and that's what I'm looking for. My bias, as Josh talked about early in the call, is that I'm looking for that bias to see if one of my trade setups is in play that day. And if it is, and if that happens to be responsive, then yeah, so be it. It would be. If not, then it's not. So I'm not really focusing much on if it's a responsive day or not. Sometimes you can call it rotational day or not. Mm-hmm. It's based on what my plan is, and then is my bias, my morning bias, is that going to bring one of my my plans into play? Remember, we can only take out of the market what the market gives us, right? We can't force our hand on the market. At least I can't. Josh may be able to in the fats, but I can't do it on my own. Millions of contracts need to be fired off. So I hope that helps hope that answers a question.
Yeah. So if you want to, I want to see that merge composite. So it's going to be a little tricky. So this merge composite is actually, or this composite over here is actually of both the Globex and the RTH session on this platform. So I recompute that. Hang on a second. Oh man, hang on a second. We got to go look at wheat because they're coming back to IB high.
Because of all the wonderful things it does.
That is a wonderful thing it does. Look at that.
If you're from Kansas, you'll know what we're talking about.
Yeah. That's cool. They just need another tick. So we'll come back to the wheat here in just a second. But let me merge this and show you what this looks like. So to compute this, this actually concludes all the Globex. So if I go 1, 2, 3, 4, 5, if I include just today's, I can set that. It's going to redraw it a little bit. So that's the most current merge profile, Nick. You know, and other ways that you could do that is if you take out the Globex, which is low volume anyway, you just merge those. It's pretty much going to look fairly similar.
Yeah. Nicholas has a good question. So he says, or actually a comment. So most traders' money made on a trend day is not theirs to keep in the first place. Yeah, I would say for the most part, yeah. If they get lucky, it's going back in somebody's pocket. But for the savvy trader, they'll keep that money.
They close those singles. They did indeed. All right, that's going to have to draw that back. Okay, I want to go look at this wheat trade. So we've been talking about, we were talking about wheat. So opportunity. When we're answering these 4 questions around the market, we're always looking for opportunity. That's where we start with a trade idea. So, which is a little counterintuitive to how most people learn how to trade. They start with a trigger. Okay, so most traders look for a some kind of price action trigger to tell them get in the trade. The problem with that is if you don't marry that to an opportunity, how do you know that that's an attractive entry to be? And JP can tell you, I can tell you, from being on the institutional side, all the pros start with there's opportunity there, and the opportunity is not a price action trigger. The opportunity is some other dynamic, whether it be a divergence between price and fundamentals, or in this case, a divergence between price and value. So if you look at wheat here, we're looking at the May contract and wheat futures, one of the grain futures. There's a divergence between the most traded price at $4.92, so $4.92 a bushel, trading $4.56 right now. Okay, so there's about 40 cents of opportunity, because as auctions go, and this is financial markets, it's housing markets, whatever market that you want to be in, when there's a divergence between the price and value, we look for these to converge. Okay, now sometimes price, the value moves to price, okay, which would take away the opportunity. But right now, while there's this divergence, that there's opportunity there, and you can see that the profile has lost participation as it's gone lower. So it's going lower, but it's running out of people at those lower prices. So that's why auctions will respond back to try to find more energy and opportunity to go lower. I actually think that there's an area right here around 467 that they would respond back to see if they can find some more sellers to go below. If they can't get below 467 again, then the next reasonable place is this 492. Now, that's the opportunity. Then the next thing that you're looking for is some type of trigger, okay? And auctions, much like thermodynamics, objects that stay in motion tend to stay in motion until they're acted upon with an equal and opposite force. Okay, so what shuts off a downward auction? Buyers who can absorb the sellers and counter them. Okay, so this is actually a 30-minute chart. This is using equivolume bars. So it's basically overlaying a 30-minute candle with the volume for that. So it allows you to fairly quickly see where the big volume is. And we have been successfully trending lower for quite some time, and actually even saw some decent volume happening today. And now here at the close of the session, you're seeing buying that's canceling out selling. Okay, so when you start seeing them cancel that out, that's telling you that I've got somebody who's starting to shut this thing off. Now, that doesn't mean that in my book, that's the turn. But if they can come back and trade above 458, which is back above the IB high, then that means that Monday I'll be looking for trades down to this 447 area to trigger back up to 468. So now I know that there are other buyers that are willing to be active with size at these prices, and so I can lean on them. But this is the behavior that we were looking for. Didn't actually think that we were going to get it, and the stats still hold. I mean, the ability for wheat to trade above 458, there was only a 30% probability that we would do that once we got below. So we stayed on the sidelines, aren't doing anything, still won't do anything until we trade above that 458. So I'm just putting an alert here. What I will likely do is if we trade above 458, I'll start legging into the swing trade because I'm going to be looking for 468 and 492. And then, I'll add to the position down to 447. I'm wrong if we make new lows, is kind of how that works. But that's giving me a window of risk in the trade towards the opportunity. So opportunity starts first. Okay, so we talked about the trend. Yep. Speaking of ag, are you still in that FATS trade? I am in a FATS trade. I'm also in a hog, in the lean hogs. Is that the one you're talking about? I can't remember which one we covered. Oh, cattle on Twitter pick. That's been weeks. Then probably not. I think I booked that one. I am actually interested. Let's look at fat cattle here. Fat cattle is a pretty interesting market. If you want a market that has very tight hours, it only trades from 8:30 Central. So most futures are quoted in Central Standard Time, or 9:30 Eastern New York time. Trades till 2:05 Eastern New York time. But here's a product that it has a really tight session, no overnight trade, and $1 per contract is about $400 P&L, and that's about the ATR for that product. Wheat just took out its IB high. Sweetness.
Quite the reversal there.
I like that reversal. Hang on a second. Okay. So this product is really cool in that it's a smaller product. It's fairly capital efficient. You see that there's quite a bit of volatility that takes place in this product, and that's partly due to the fact that it's less liquid. It's the most liquid of the meat contracts. So there's fat cattle, feeder cattle, and lean hogs, but it is the most liquid, and with about $1 to 25 cents per day, you're looking at a potential risk window of about $550. So can be kind of a cool product to trade. Right now, I'm looking at the fact that on the monthly value, you can see here is at 127. There's a couple other nodes here, 129, 79, 128. I'm most interested in the fact that we actually opened, traded higher above the first hour's range, then came back to trade low, moved towards this inventory level here. Remember, we talked about how the auction moves between these larger inventory levels. It's bouncing back now to this level. If they would move back through this one, that sets up the condition that they could move lower. Now, it could also be the condition that more trade here migrates this point of control higher, which is actually a form of the auction accepting. And then unless it got acceptance below this level, that could give it power to keep going higher. And to further illustrate that, let's go over to this long-term chart. We were talking about this earlier for the S&P. So this is S&P futures. This is a long-term chart, daily candles or daily bars, and looking at the merged profiles. So this is from the beginning here to this move. That's what this profile is, and then this is from the bottom here to where we are currently. Okay, so just give you some context. Now, people might say, well, why did these? I'm sorry, this is Nasdaq. Why did the Nasdaq rally the way it did? The auction spent a lot of time building out acceptance, and then it exhausted itself. It ran out of participants to the downside. So for the auction's either going to do two things. It's going to either trade sideways to change this picture, or it's going to come back towards prior value. And what did it do? It came back to prior value. Okay, and now as it did that, it moved higher, bounced for a little bit. You can see that there is a node that was built out here. Try to get acceptance below that, came up back above that. So then that makes that a nice downside reference. Goes, balances some more. Okay, builds out this node here, pushes above that. Where does the auction come back to test? It comes back to test that prior node. All right, can't get acceptance below that, so then it balances some more. Here's another node, here's a new move. Okay, now this move takes us back to test this larger area from a prior auction. Auction spends some time around here accepting these prices, pushes above it. Then where does it come back to test? It comes back to test this prior area, can't get any acceptance below that, comes back above that, then it moves back again higher. Now we're back up into this area. Okay, so it just, the auction will come back and forth and test, you know, like this stuff between these levels. And so like where we are even with the equities right now, we've got an area right here on 70.40 that unless the NASDAQ can get below 70.40, I mean, it could easily just push down below that and then find acceptance to move higher. If it can get pushed below that, then it goes in reverse. Then it's going to go look around for this level, and then we're going to go down look for this level. Likely not all in one sweat, not in one move. We probably push through, come back, push through, you know, like that. That's kind of how it works. So that's kind of the same thing that is potentially at play when I look at this fat cattle contract on the long term. Okay, here's the longer term chart. You can see this just long move here. So I've actually got some references that are downside references where there are prior areas that the auction could test. So there's a very small one here, which is, you know, kind of where we're at. That's why if we get below that one, then we can come back to this next area. And that's basically how we, you know, build a perspective of where we think it's going to go next. Okay. Yeah, so that's
a great question. So it says
yes.
When you close out a trade, do you account for, what was that? I missed that, Josh.
It was maximum favorable excursion versus maximum adverse excursion.
Yes, but not in those terms.
Yeah, I do in those terms. And what that looks like. So like here, let me just show you. So this is a trade log of trades that we talked about inside of our community.
You blow that up a little bit?
Yeah, let's make this bigger.
There you go.
Wait, too much. I needed to wait for it to.
That's the guy who has bad eyes.
So what this does, and if you don't have a trade log like this, I'd encourage you to have something similar to this. But, you know, you look at the date, you look at, did the trade win or lose? What was the P&L on the trade? What was the product? You know, were you long or short? What was the entry? When did you enter? And then here's that max favorable excursion or max adverse excursion. What this is saying is, you know, while you were in the trade, how much did the trade go in your favor? And then how much did it go against you? And if you're building really well-defined trades, you will find that the trades go for you farther than they go against you. Okay, and that would prove, if you go and look at the trade logs from this week, you know, we try to define them as, I mean, some of them actually we never had adverse excursion. Like as soon as we got in the trade, they were in profit. And you know, if you're reading the order flow well, you know, that happens more often than not. And then, you know, what was the setup? You know, what was the predefined target or stop? So, you know, when you get into a trade, you predefine where the target is, what the stop is, what's the setup, and then where's the entry, and then you reconcile this at the end as a way to look back and say, did I read this trade right? Was it built right? And then the R value, that's tracking, you know, when you're building the trade, what's the reward to the risk? Now my review this week is I'll go back and look. This is actually pretty low I like to see these above 3.0 because
Mm-hmm.
that tells me that my reward is 3 times my risk. And if that's the case, then I don't have to have as high a win rate. So like right now for this week, our win rate is 78.95 with a 2.29 average R value. So that means you make money. And that's actually since the beginning of January. This week we had a 100% win rate. But you don't always have that high a win rate. So that's why.
Yeah, and one thing, so whatever you use to language, like I use Heat in mine. I have a big spreadsheet program that I use. It's actually similar to what we see right here. This is the one we offer in our community, but it does help. Okay, I use the R value as well. I think that's probably my biggest tell at this point is to keep that R value as high as I can get it. Again, you have to define what type of trader you are. Now, we're not scalpers, and when Josh spoke of scalping earlier, scalping is the guys that are going for ticks. NASDAQ is very difficult to scalp that way, because it's what I would call an itchy product. You could probably do that maybe with the ES. I think there's some successful people out there that does that. It just doesn't fit my personality, and nor does it fit Josh's.
Yeah.
So you got to know where that R value works for you, okay? Because maybe that 2.2 that Josh shows on there, that could be an incredibly big R value for you. Where for us, that's not what I would like. I'm with Josh. I want it over 3.
Yeah. And why over 3 is because let's think about this. So if you're defining trades from by the way, when we define that opportunity, that's because there's an expectation of hitting that target. So it's not. I have seen traders who will say, well, every time I put on a trade, it's I'm 3 times the reward to the risk. And I ask them, well, what's the rationale that you're going to hit that level? And they're like, well, I'm just going to hold it until I get 3 times. That's not what we're talking about. I mean, we're actually talking about, is there a reasonable expectation for hitting that target? Then how can I tighten my risk against that? That's very
different. I will tell you, we know somebody who does that, and that person could hold that position for months on end, and sometimes even hurt themselves by blowing up. So,
yeah.
Not a good way of trading.
Not a good way of trading.
Nicholas, you have a good, not question, but an observation. Notice ES, NASDAQ, the Dow, and the Russell are all taking turns on rotations. Normally that's an indication of a healthy market. You don't want to see one diverging. Yeah, I mean, of course, if all the markets are in lockstep, it's stronger, no doubt. They're diverging. You got to sort of scratch your head and go, okay, who's lying? It's a game of liar's poker. Who's lying?
Yeah.
And somebody's lying. We'll figure it's the same thing with the bonds and the equities, right? We found out this week who was lying.
Yeah. Yeah. I think we got time yet to get those singles in the ES and the Dow, quite honestly.
I hope not.
They cleaned them up in the ES or in the NASDAQ and the Russell. Well, the Russell didn't have them, but they cleaned them up in the NASDAQ.
Yeah.
Man, look at wheat. Love it. Now 454 would be a pullback level to get long. 447 would be the risk, and then that 465 is target 1.
Mm-hmm. Now on the NASDAQ or the ES and the NASDAQ, I'm wanting it right here to stay, and preferably on the NASDAQ to get back into yesterday's range before the close of today. That would be great.
They're back neutral on the order flow. The delta. They're back neutral on the delta.
Mm-hmm. Yeah. That would be really freakish if that would have happened, especially after. I mean, not to say it won't happen, but man, that would be pretty freakish. So.
Yeah, I don't know. I think it's suspect that they couldn't hold below 71.12.
Yeah, hold, but if you look at the NASDAQ or the ES is not sort of lethargic up here. And excuse me, the ES is just not, doesn't look like it wants to rally any further. So that has an opportunity to get back into yesterday's range again, pretty, not easily, but it does have that chance. NASDAQ's not looking too hot right now. It looks like the NASDAQ still wants to rally.
Yeah. That's...
May you got any other questions? Do both of you speak to your wives grow? Absolutely. My wife's a trader, so I have to speak to her. Believe me, those are not good conversations if you're not doing well, because if you know my wife, she looks at me with that weird look on her face and go, what the heck are you doing?
That's funny.
And I'll tell you what, you want to get straight with your trading quickly, talk to your wife about it.
Absolutely.
Or your significant other.
Yeah.
Now, of course, if they're ones that just say, "Oh, you're just gambling," that may be a little tough conversation. But if you have somebody who understands, maybe that you can put some odds on your side of the fence, and if you do it correctly, it works out pretty well, like a casino. And so, what I would say is, yeah, talk to them. It's a good way, because to be honest with somebody, it's just like working with Josh or I or somebody like that. You can tell us, but we're going to probably tell you if you're doing wrong, or we're going to ask you some hard questions that you're going to have to answer. So, hiding it from people like that or keeping it away from them, I don't recommend it. Okay. Yeah, you should see some of the conversations we have about that. My wife always tells me, sounds like I need to get back in there and take over for you. Yeah, thanks. I appreciate that. So.
Oh, that's awesome.
You use her to grade your trades? No, I grade them myself. She'll look at them, so she knows them. I mean, we do the same thing. She's not active anymore, but she traded for some time, and so she leaves that to me right now. Yeah, she'll let me know when I'm wrong. That's for sure. She's not shy about that. I laugh it off, scratch my head, and just go on about it.
Oh, that's funny.
Yeah, what we do, honestly, is if I have had a bad week, okay, so full disclosure, I'm going to tell you what I told the team today. I had a big boo-boo this week. Man, it was just a dumb mistake on my end. And there's nothing else I can say except it was just stupid, okay? So I was in a trade, or excuse me, I was trying to get into a trade. I wasn't in the trade. It never triggered on me. So I took one of the trades off, but what I did is and I typically don't do this, I put a trade, a target up there, because sometimes if we get a good move, it will happen quickly to target. So I want to make sure my order's in there, because it's, what it is, it's, first in, first out on the trade, right? So if you understand that in the book, okay, so if you get in, so if there's 100 in the dome, Josh, you have a dome you can pull up by chance?
Yeah, hang on a second. I've closed most of that, so.
I learned this a long time ago. This would be good for you guys, especially if you're bond traders or something. This is why I don't trade bonds.
Here, hang on a second. I'll pull you up.
Yep. All right, that's cool.
I've got it on my other. It's just going to take it to load for a second.
So there's a term, I guess you can look at your last in, last out, or first in, first out, right? So there's a couple of different ways to look at it. They both mean the same thing, I guess. Once this dome comes up, I'll explain a little bit more. Not that it excuses me from being really stupid, but it just goes to show that, mistakes can happen and you got to be on top of that.
There you go.
Okay. Can you sort of, I don't know if you can really blow that up or just pull it to the middle? Okay, so you guys see the dome has depth on it. I call it a dome because a dom really sounds stupid. So you see we're 10 deep on each side. And when I mean 10 deep, you can see the numbers in red and the numbers in green. And that means how many standing orders are there. They're always switching around. They're not always going to be static. So when I place an order, so at the top of that, you'll see, well, if it doesn't move on me, it says 30 right now at 44. So if I were to place my order in there, I'd be 31. So before it gets to my order, that means it's got to go through 30 contracts to get to my order. Now there's contracts jumping in and out all the time. So my place in line is going to improve as time goes. So when I get into a trade, I identify a first target right away and I put my order there. So I can get in before everybody else can get filled if it's just a touch, right? All right. So with that understanding, I placed an order up above the market because I was looking long and I wanted out of the trade when I got there. I wanted to have a good place in line. So trade didn't happen. I took off my order and I didn't see, because it was so far up the ladder, I didn't see my other order and I didn't click out of the deal. And I got sidetracked doing some of it. It was a really boring day that day and I thought for sure it was going to happen. Well, guess what? Later in the day, and this was what day did Trump speak? Was that Wednesday on China? I think it was.
Yeah.
Yeah. So I'm starting to shut down my charts for the day. And all of a sudden I get this notice, you have an order open. I'm like, what the heck? What order? And I'm thinking, I don't have any orders. And I'm thinking, okay, I've got option orders, but I don't have anything else open at this moment. And of course I look at it, and after Trump spoke, the market tanked a little bit. And sure enough, I was caught in that trade. I was long in that trade because my order never got cleared out of the book. So I hit out of it, lost money on the deal. And yeah, that was, you want to talk about your wife, about your stupid mistakes. That was one that was not going to be fun on my part. So, so you want to know the reaction from her? So she looked at me, gave me that funny look. She goes, "Nice job, Einstein." So
that's awesome.
And then my kids go, "Come on, Dad, we never even made that one. What's wrong with you, man?" Like, hey, man, it happens.
That's funny.
So it does happen. Just so the lesson there is, clear your book out when you take an order off. Don't pull what I did. It sucks. It was a good amount of money, believe me. It was a dumb mistake. So it happens. But I was still positive for the week, which is good. We all been there. Yeah, we've been there, Nicholas. Believe me, Josh and I are not. How do I say it? We're very knowledgeable about this industry. There's no doubt about it. I mean, we've seen it all. But the reason we're knowledgeable is because we've made every mistake in the book. And I think one thing that drives me nuts in life is when I hear somebody, "Oh, that's the price of entry," right? And okay, you're going to make mistakes, whatever you do in life. It's not the price of entry. That's part of learning. And if you want to say it's the price of entry, then go for it. I don't care. I think that's sort of I'm gonna say it's dumb. I just don't like it. Okay, because you said it alludes to, okay, you can't get there unless you make all these stupid mistakes. Now you don't have to make that mistake to be a good trader. Right. Josh and I have just made those mistakes in the past. I don't even know, Josh, did you ever leave an open order or got filled that you didn't know about?
Yeah, absolutely.
Okay, all right. So we both made it, right? Yeah, so there's a few things like that. Now, I'll give you a tip. Here's a great tip. And you may not think of this one because guess what? Been there, done that. And Josh, you know what I'm talking about. The exchange, made me think of this, and I didn't tell the community this, but the exchange went down, was it Sunday night?
Mm-hmm. Yep.
Yeah, Sunday night into Monday.
Yep.
All right. All right. If you're in the US, you're sleeping, so it's no big deal, right? Unless you have an order on. All right. And this was a long time ago. I mean, that's almost probably 9 years ago, maybe 10 years ago. But I had a corn. I had an order on the corn market, and I remember this specifically. I was long the corn market, and there was a trend going in the corn market, and the CME exchange went down in the middle of the day. and it was down for a couple hours. It was maybe even more than a couple hours, maybe 3 hours, and nobody could get out of their trade. And so this is when I learned, okay, you better have a plan to cover, do something to take care of yourself. Now, this is before before I understood what to do on this deal, but naturally what I did was I went to the options market, and I was able to get a hedge on to protect myself. But I will tell you what happened. As they were aggregating orders, is what they typically do before the open of a market. They aggregate the orders, and you can look up that term and understand what that means. But they were aggregating orders to reopen the market once they got the problem fixed. At that point, I knew we were in trouble, because most everybody's long. Guess what everybody's trying to do at that point? Get out of their trade. Well, they ended up gapping this thing down on that open, and I mean, it was a bloodbath. It was terrible. I lost a ton of money on that deal. Now, I was able to hedge a little bit. I wasn't totally hedged that I needed to be on the other side, but I covered some of it and reduced my damage. But what I learned from that was I need a disaster plan. I need to know what I can do right away to take care of it. So whatever markets I trade, I make sure I understand what an equal hedge would be if something goes wrong with the markets. Because you know what? This is technology, and it will happen someday. It will go down. Okay. Just understand you have a plan, and you should have a plan if your computer goes down. Okay, if your computer goes down and you have a trade, you should have your broker on speed dial so you can get out of that trade immediately before it gets away from you. And make sure whatever broker you're using, if you have stops in, that those stops are not on your local server, which would be your CPU or your laptop, that you have those stops on the exchange, or what they call on the server side. And if you don't understand that, you can shoot us an email or something, and we'll explain it to you. But yeah, those are little things like that to help you, so you don't lose money. I say they're foolish, but that stuff happens sometimes. So what I did was foolish. There's no doubt about it. I was dumb. So I was distracted. That's not my excuse. That was just a fact. It doesn't make it right.
Oh, man. Thanks, man. Thanks for sharing your pain.
Yeah, it happens. So, I mean, at this point, as Josh can probably tell you, we're beyond the pain point anymore. I mean, painful if we would have to wipe out our accounts, which that would be quite the feat to do that. That would be painful. Right now, doing something like that, yeah, it sucked and it was dumb, but I'll recover. It's not going to be a big deal.
Mm-hmm. Question about data speeds on premise. So just upgrade to FiOS rather than cable DSL. Is that fiber to premise, Nick?
That's huge.
Yeah, nice. Yeah, so one city south of me in Longmont, they have Google has Google Fiber, which I'm very jealous of, and we're gonna have we'll have fiber here in about 2 years. So I'm actually, I just have cable and I have a DSL backup. This is another reason why I don't scalp, because it's not that important that I have that type of speed. But I don't know if you noticed, but all of my analytics stuff I'm running, all these charting platforms I'm running in AWS through Amazon. So basically what you're seeing is me running my trading desk in a client that is on a server in Oregon, and that has fiber to that backup. This is also part of my redundancy plan, is that if my local machine crashed, I can immediately pull up and see all of my charts on my iPad, a laptop, and so forth. And it costs $70 a month, but it's been way worth it for me to be able to have that. So that's at gigabit speed there. Here at the premise, I have like 150 meg up or down, and then I've got a bandwidth aggregator that if I have one provider go down, then I've got a backup provider.
Yeah, it doesn't matter what it doesn't matter what you use or how you use it. What matters is you have the plan just in case something goes wrong. Yeah, I mean, those are great speeds. There's no doubt about it. I mean, mine are 100. I'm at about 100, just over 100, as far as speed is concerned. Mine's off cable. I do have a DSL backup, but it's actually slower because where we sit from the box on the deal, we're so far away from the box that it just, you know, dribbles in. So I don't even use that, to be honest. It just sits there and it's cheap. So it's just if I need to get out of something. But man, my phone is the main source for me to get out of anything. So. That's a lot of speed. I've not seen that. What are Google Fiber speeds? I don't even know. I wish we get it. We have it here in the Valley, but I think it's in Tempe actually. So.
That's fast. How long or how many trades for you to become painless emotionally?
Good question.
That depends on the person and how. And so we were talking about this earlier, JP. So no, I was doing a one-on-one this morning with a trader, and so we were talking about the dynamic around traders who like early on find a trade that works, and so the brain wires that's a good trade that they should look for again, but without the context of knowing what made that trade work or knowing that was an outlying trade. Okay, so what happens is the brain will reinforce the thing that statistically shouldn't happen. It wires that connection. So you actually have to then rewire the brain to look for the correct thing, and that depends on everybody's cognitive ability, quite frankly. Their ability to rewire around that. Also, when you add to that the complexity of, I can take the right setup and still be wrong on the trade and have to teach my brain that was still the right trade to take.
So how long does that take?
How stubborn are you?
Yeah, how stubborn are you? So let me give you an example. I had a trade this morning, one of my favorite trades. I trade that thing. Oh, that's my favorite trade. I'll take that one every day of the week, as long as, like Josh said, you have the context around it because you know what makes it work. That trade shows up in times where the context doesn't work, and you will lose money on that, typically on that. But like this morning, the context was perfect. It was like licking my chops this morning. Like, this is going to be a beautiful day, and it was. And you know, I'll do that one all day long. And even if I lose on the trade, I'm okay with it. It doesn't matter. It's just, I know that over time I'm going to win on that trade. And so I guess you get scarred, I guess, a little bit over this stuff. I hate to use the word scar, but you get to a point where you're like, okay, I take a little loss. That's no big deal anymore. Okay. And I think that goes with, for me personally, is I know how to manage my risk very well. So I know that nothing's going to get totally out of control unless I do really a bonehead thing like I did this week. You know, if I'm actually trading the trade, it's not going to get out of control on my end. I'm just not going to let that happen. I'm too stubborn for that to happen. If anything, I'll manage my risk too tightly, which could be considered a problem too. But I think just years of reps, you know, I don't want to say take a beating, but, you know, just, you have to understand, like Josh said, finding, you know, you see a trade and you identify an edge, but you have to understand what makes that edge work. Yeah. Once you do that, you understand it in your mind, then once you start what I would consider testing it, and not back testing it, but forward testing. I never back test anything. And you can still forward test things in sim. That's okay. Just make sure they're correct and stuff. Then your mind, then it's one of those things you have to trust it. So I played golf at a high level at one time in my life. And the thing about a golf swing I met guys that have beautiful, I met guys that could kill Tiger Woods. I mean, no doubt they could kill him, but they don't mentally have what Tiger has, because Tiger trusts everything he does. So he trusts his swing. He trusts that he can hit that shot because he's probably hit that shot a gazillion times. And he knows that if it misses, what's going to happen to it. And he has that process in his mind. And so if you ever watch golf and you listen to it on the weekend, you'll listen, maybe sometimes they mic them up and you'll hear a caddy say, trust it. Okay, because they know that's the last thing that you can do. These guys have hit that shot a gazillion times. They know how to get the ball in the face of the club. That's the easy part. The tough part is just trusting it and letting your emotions get out of the way. And so the same thing happens with trading, is that, you get nerves in trading, you have nerves in golf. Get on the first tee of a golf tournament, knowing that you're there to make money, to make a living, and you will definitely feel it, I promise. And I'm sure some of you pull the trigger on a trade and it gets a little nerve-wracking. You see the couple ticks go against you, you see a point go against you, and you're like, oh my goodness, here it goes. I'm going to take a loss. Okay. Go back to your process again and trust it. Is this your trade? If it's not, get out of the trade. Is this your process? Do you have your stops defined? Do you have your targets defined? It goes back to the basics. And then once you have that, you can trust it and start getting past that mental side of it that gets in your way and the pain of that mental side of it. There'll always be a little bit there. Okay, you're not going to become a machine, so don't ever think you are. There will always be a little bit of that, but you have to be able to temper that with your wisdom, that you know that, okay, this is my trade. I'm going to trust it, and I'm gonna. I think I've got the boys reading Mark Douglas's books now, and part of what Mark Douglas talks about is accept it and let it go. As long as you've done the work ahead of time, let it go after it goes through that. Once you get the reps in, and what I mean by that, once you've done this a lot, because this isn't, people think trading, and I'm going too far, Josh, to stop me, but in trading, people think they can just show up and put a trade on and make gazillions of dollars. That would be great, but it's not always the way it works. Back in the late 90s, yes, okay, grandmothers were making millions of dollars in the dot-com run-up. Okay, that was an anomaly and a big outlier that hasn't happened in a long time. We don't see that kind of movement, and so you have to go back to, really hitting singles and doubles in your trading and stuff, and go back to what really works. And that takes time. As much as I like to say that we can help you get, cut some time off, we can, okay? Because we Josh and I have seen a lot of things, and we can help you get through that. But with that, it still takes time, okay? And that's something that everybody needs to understand. And whatever you're going to do, and do it really well. And in my opinion, this is worth it, because I'm there. I know what that's like. I know that I've had the times where I felt, oh, this isn't worth it. This sucks. I'm losing money, man, this isn't working. Will I ever get past that hump, or can you really make money in this industry? That was part of it too. And there's times you want to throw in the towel, but if you're able to work with somebody like, have a coach, whether it's Josh or I, or whether you have your spouse involved, it doesn't matter. Okay. You have a team member that you can bounce things off and start to get better on that stuff, and do the work that gets you there. And then take the time to get your head right, because your head has to be right. Okay. Like I said, I met a lot of guys that could play a lot of golf. And one of my favorite ones is, I remember when I first turned professionally as a golfer, and I got to my first tournament, and I got on the range, and I was like, oh crap, look at the swings on these guys. They're going to destroy me. That was my thought process going the first tee. But then when I got to the end of the tournament, none of these guys made the cut. And I was just like, shot. How could that guy miss with that golf swing? I mean, these were guys that were really, really good, but they mentally didn't have what it took to play. And that's a different ball game. So I would say work on your head. Okay. Work on the reps. Josh had some great comments there. It's believe me, it'll pay dividends. I didn't know Dalton may use card as terminology, but yeah. Speaking of Mark Douglas, he has a great point in a YouTube seminar I found. He said if all it takes is one trade to negate your entire hypo, the market, despite edge given, is completely random. This doesn't mean you can't make money from randomness using probability, but in reality, every trade is random. Yeah, I mean, here's what it is. If you can get into the trade and identify your stop and your risk, as we like to call it, and your targets, and it makes sense contextually, okay? So in other words, do you have the room for this thing to run? Do we have some I would say at this point, unfortunately, Mark has passed away, and before Mark passed, or after Mark passed away, there's a lot of order flow stuff that's out these days that can give you a better context of what's going on in the market and who's in control. So while the market can be random, there are patterns that play out on a base. I mean, these things have been playing out for hundreds of years. And if we had profile back 50, 60 years ago, I think you'd see the same patterns. Mm-hmm. So again, based on those patterns, I think that you can make money as long as you understand your risk and how to manage that. And again, manage your emotions as well. See, also defined as gambling because trading meets the 3 requirements noted in gambling process. I don't know if I understand that, Nick, but what I would say is that you don't want to be the gambler, you want to be the casino. And the way the casinos make money is they have the edge. Okay, albeit slight, and if you understand how a casino works, the casinos know they're going to have big losses. Somebody's going to come in there, the Phil Ivies are going to come in and take them for about 10 million. But it's all the little ones that are losing, all the what we call pikers, and I use that terminology all the time in our room. The pikers are the ones that are going to end up giving all the money back, right? And so you don't want to be the piker. you want to be the casino. And that is possible in this marketplace. Yep. So anyway, I've rambled on way too much. So sorry about that.
We're gonna do this. We're gonna wrap up for today, and just real quickly have some practice for you for next week. Is to determine a key bias level for the coming session. Monitor the behavior, and follow through if the level is touched. See if adding a bias level to your trade adds some meat to your daily plan. If you want to dive more into the bias stuff, then do a week with us. We're going to be talking about this several calls next week, as well as we're going to give you an anchor trade that you could add to your trades playbook. Please interact with us on Twitter and Facebook. And then again, any questions you want to just call. If you're struggling, I mean, trading is a difficult industry. It's a simple thing that we're trying to do, but it's a difficult industry to be in, and everybody needs a friend, So if you need somebody just to flesh out some ideas, I mean, upfront contract, we're just going to give you a fair shake. And yeah. I mean, obviously we believe in what we're doing and how we're supporting traders in the market. But we're always also sometimes not a fit. I mean, sometimes a trader has actually a reasonable playbook and approach to market, and they're having trouble getting on the performance side of that. And we have other partners in the industry that we connect you with and say, hey, go talk to them. They're doing some great work there. Don't struggle unnecessarily. Build a plan, work the plan, put in the work, and I think you'll see some positive expectation on the other side.
Yeah, I'll agree with Josh. It's a lonely, this trading can be lonely because you sit by yourself typically, and a thing. I mean, that's why the prop shops are great until the Dodd-Frank came along, unfortunately. But yeah, listen, it's good to bounce things off people. Bounce them off us. We want to hear what you have to say. We just want to help somebody get better because we've been there, brother and sisters. So thanks for being here, guys, and good questions. And Nicholas, thanks for the thumbs up over there, bud. Hopefully you guys got something out of this, and then we will see you guys next time too.
Yep. We'll be back next Friday with
you guys have a great weekend.
Peace, everybody.
Peace.